Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, February 7th, 2025. S&P 500 currently sitting at 6044. I'm David Zong here with Ned Ryerson, Kevin Ferrari. Welcome back onto the show, man.
Yeah, thanks. So glad I got to come back for the 2025 Groundhog Day Gap Down Monday show.
Yeah, I guess that's just what we're going to do each week is just gap down on Mondays.
Now close red on Fridays, gap down on Mondays. Just back to even by the end of the week and rinse and repeat.
Yeah, how does that work? Groundhog sees his shadow, then what happens? Is this like the market seeing its shadow?
Yeah,
I
maybe.
forget how that works.
Actually, somebody's had to have put that together, right? That's got to be a thing that's out there already.
Yeah.
What the returns are for when the groundhog sees his shadow.
Yeah, I mean, probably should. Probably. I mean, that sounds like something we could figure out.
If it doesn't already exist. Oh, look at this. Harvard Business Review is on it already in 2023. Yeah.
For them.
I'll have to, while we do this, I'll scan that, see if I can figure it out.
So Punxsutawney Phil, his accuracy rate is 36% for the weather thing.
Probably better than your run-of-the-mill meteorologist, I would think, huh?
Kind of crazy. I mean, he saw his shadow on February 2nd, which means there's going to be 6 more weeks of winter. And if he hadn't, we supposedly could have. So now we're sitting at a spot of like 70% chance that it's going to be spring early. They should really reverse this. This is very confusing.
Like just change the criteria, just flip it.
Yeah. This is very, very adverse accuracy here. But to your point, the past 2 weeks, we've had a gap down on Monday, climbed all the way back to previous levels, started green on a Friday, end up red, and then gap down again. So now we get to find out if it's the same thing this upcoming weekend.
Right.
And who knows? Maybe investors are just nervous to hold stocks into the weekend. Maybe there's just too much winning.
That could be.
People get nervous when things get audited. Shouldn't people get nervous when they get audited? When people and corporations get audited, they probably should get nervous. I mean, the government's being audited now. I would think they would be nervous.
Yeah, I think that's pretty natural. Just when you're, like, even if you're not doing anything wrong, just the fact that,
right.
I mean, like if you were going through an IRS audit, like just the fact that you're talking to an auditor, I think would make you nervous. Kind of like getting pulled over. You're driving in your car. I mean, it's just kind of natural. Going to the doctor, going to the dentist, kind of the same thing.
For sure. But we definitely have had some volatility, painting the bigger picture. It was Q4, specifically November 23. We got all those breath thrusts in the market. Market continued to rise through then. Had a great 2024 uptrend intact. Another round of breath thrusts in the summer. Had a little bit of a pullback in July, August, then moved higher. December was negative, but then we had, a positive January, which seasonally speaking is good for the market, if that holds. But we also know that February is notoriously the weakest of the 6-month period. When we break down what's the strongest 6 months in a year, it's November through April out of a 12-month period. And in that 6 months, February is the oddball. It's the Punxsutawney Phil
of all the months.
The Ned Ryerson of all the months.
Mm-hmm.
So, it'll be interesting. It'll be time will tell. And I appreciate you filling in. I know Ian's spending some quality time with his wife, Kate, and that's probably necessary going into Super Bowl weekend, considering she's an Eagles fan and he's a Chiefs fan.
It'll be a tense time in the household, I would think, this weekend.
Yeah, I think they got to just make sure that relationship's tight. Maybe watch the game in separate rooms.
I was actually just thinking that. You think they watch it together? I don't think I could do that.
I'm guessing they do. They seem like they're pretty strong.
Mm-hmm.
But then maybe then there's another day off next week where they just got to recoup.
Could be.
Like Vince Vaughn, I just got to sit over here, put some maple syrup on my pancakes and recharge. We'll see. Did you know that there's seasonality with who wins the Super Bowl too?
Did not until that you informed me of that.
Like, I think Ryan Dietrich put this together about when Philadelphia wins a championship, pretty bad things for the market.
Right.
So I know that a lot of people are cheering for Philly because the Chiefs have gotten so good, they're easy to hate now. Like,
they're the new Patriots.
Yeah, the new Patriots, right? Yeah, that's how this works. Is you get so good, and then eventually everybody hates you. So most people are cheering for Philly, but when Philly wins a championship, not great. So like the Athletics, the Philadelphia Athletics, 1910, 1911, 1913, 1929, 1930.
Now here's the kicker. Had a rough 50 years there, or a little bit.
Yeah, they did. I mean, it wasn't until 1980 that the Phillies got a World Series. 2008, Phillies won the World Series, financial crisis. 2018, the Eagles won a Super Bowl. Worst stock market year since 2008. I don't know, man. Maybe, when you're watching the game, I know people out there who are listening are going to be probably cheering for Philly.
I have that in the back of their mind, though.
Gotta.
Maybe they'll end in a tie. Wouldn't that be nice? Everybody wins.
What college game was that where they went to like 8 overtimes? It was this season. That would be wild. Talk about ratings.
Just give up.
You have a team you're going for? Yeah, me neither. I'm there for a great football game. I think
as long as it's enjoyable, that would be.
Yeah. I'm there to watch great players like Mahomes and the offensive line of the Eagles and Saquon Barkley. Those guys are amazing. Now, we've gone on a lot of diatribes here.
Yeah, that escalated quickly.
I don't know if people have turned off the podcast yet, but maybe we should talk markets. So we've had this new characteristic of gap down Mondays, reclaim those levels, get back to near all-time highs, get red on Friday. Time will tell. We'll know on Monday whether that's the case again, that we're going to have another gap down. But what else are we seeing out there besides just broad market speaking? We talk about the S&P 500 a lot in here, and that's fair because it's a basket of 500 stocks that are cap weighted, reflects momentum, reflects the best stocks in U.S. markets for the time being. There will be a time where the S&P 500 is not relevant, but has been for, I don't know if relevant is the right term, but as dominant as it has been. It's a dynasty.
The chiefs of the market.
Yeah, chiefs of the market. So what else? What are we seeing maybe underneath the surface? And then I'll let you take it anywhere. You can go with stocks, bonds, crypto, commodities.
Well, I don't know. You want to get the bad out of the way first or go with the good?
Let's go. Let's rip the Band-Aid off.
Okay, the bad. Get it over with?
Yeah, the bad.
Well, now we were kind of talking about some names that are looking kind of like red flags currently. So I don't know, I guess where to start with each of those. I guess Apple's probably your biggest.
Yeah. I mean, Apple is the same spot it was in summer of last year on an absolute basis. So 0% return there. And then versus the S&P, I mean, this thing hasn't gone in. It's at the same level it was in September of 2020. So 0% return for Apple versus the S&P. I don't mean 0% return on an absolute basis. I just mean any type of edge or alpha. Zero alpha since September of 2020.
And I mean, that was, when Apple broke above, what is this? We'll call it like 235 back kind of towards the end of the year last year or kind of beginning of December. I mean, that's a pretty sweet looking chart, essentially through the rest of the year. And then Merry Christmas, sayonara. And they just ruined it from there.
Right. So it's been an absolute uptrend. And, we're talking about, let's not complain, like a 68, 69% return since September of 2020, but you've gained no edge by owning Apple over the S&P. And another one I think of is Microsoft.
Yeah.
Microsoft is at the same spot it was in February of last year. So 0% return for 1 year on an absolute basis versus the S&P. Also same spot it was in summer for Microsoft versus the S&P for 4.5 years. Same for Apple. Interesting.
Yeah. Kind of a lame range too, like 15-20% range.
Mm-hmm. Really hard to grab any alpha in there. And so the way these major cycles work that we have to keep in mind, and when you think about the makeup of the S&P 500, right, the big continue to get bigger. This cap weighted construction of the S&P 500 is a momentum strategy. And when major cycles end, it's when the largest cap weighted pieces stop being the strongest contributors. So when you look at, like, for example, 2007, 2008, right before the bear market there in the market, that was one of the bigger ones, down 56%. It was financials at the time. Financials were the largest weighting in the S&P 500. Now they're one of the smallest, but each cycle has new leaders, and time will tell whether this proves out to be the end of this cycle, that it's these major players like Apple and Microsoft. And we haven't touched on Google, because Google, you would say, is kind of in the same predicament.
Right. I mean, Apple and Microsoft have kind of been showing this red flag hand, I guess, for a little bit now. Google's pretty fresh, like as of this week.
Right.
With the gap down a couple days ago. And then, I mean, today's price action is pretty unfortunate.
Right.
Down a little over 3%, kind of right around a level, you call it like 190, which they held even with the gap down the last couple days, but today losing that pretty steadily. So
no alpha there since July of 21. So that's three major players, Apple, Microsoft, and Google, that are percent alpha, right? The leaders haven't been leading for years. Is that a bubble? I don't know. Like, the fact that your leaders haven't been providing alpha is worth, I think, paying attention to. And I mean, I think you could probably throw Amazon in that bucket as well. I mean, it's the same thing. Spring of 2020, 0% return from an alpha perspective. Fine on absolute. These things are the exception, probably Google. Okay on an absolute basis, but as far as like generating alpha, not so much for a few years.
Yeah. And then, like, even just the three names talked about before, Apple, Microsoft, Google, that's like 15% in the S&P right there. Tesla is another one. It'd be nice if Tesla could get its act together.
Yep. But you've seen resurgence in things like Netflix. That was a name that was kind of under a lot of duress. But Netflix is on the verge of brand new all-time highs versus S&P on a relative basis. And then you have things like Meta or Facebook, new all-time highs versus the S&P. So some rotation happening also amongst the big names is you have your winners in Facebook, Netflix, and NVIDIA took a hit a couple weeks ago with with the narrative being DeepSeek. So the large names are worth paying attention to. That would be, I think we've done a good job covering the red flags here. And I think you could throw in there, we still haven't recorded a new high in the advanced decline line for the NYSE.
No.
Typically, you like to see that confirm. We still don't have a new high they're trying. I mean, it's cleared the level that goes back to 2021. And some might call that, from a technician's perspective, a Wyckoff wraparound of prior highs, where it's consolidating near the highs. So on an absolute basis, not too bad. But are there other things that we can look at that provide us health of the markets? We have those negative things. Anything that you're looking at that's on the positive side when we look at the weight of evidence?
I don't know if I would throw this necessarily on the positive side. I guess it's interesting. Well, I guess long-term still positive. If you kind of look at different risk on bond relationships, so like junk bonds versus, take your pick, AGG, TLT. I mean, I guess you could look at, investment grade corporates, things like that. Kind of those relationships over the past couple of weeks have kind of gotten to some areas where, they've seen quite a bit of relative resistance historically and have since kind of paused or pulled back a little bit. So I guess I kind of put that more in the interesting category. I mean, like, nothing's changed as far as like the relative trend. Uptrend is still intact. So I think largely speaking in kind of the bond areas, it's still pretty risk on, which is something maybe to pay attention to here over the next couple weeks, couple months. I guess if we start seeing, right, some of those red flags we talked about continue and you start seeing kind of a regression in those risk on relationships, then you kind of perk your ears up a little bit, because I guess that kind of adds weight of evidence to maybe those red flags. So time will tell there.
Right. And I think it's worth noting too, like triple C credit spreads have moved a little higher here since January 23rd. Nothing crazy, still in a downtrend in the spread, which is typically risk on. We'll see if that continues to hold. If we continue to see credit spreads cool off, you mentioned credit. If we're continuing to see junk IEF, J&K versus IEF move higher, if we're continuing to see demand for convertibles or corporates.
Yeah, convertibles look pretty good. So, that's a good sign.
Yeah, still, I believe year to date are still one of the better credit places to be. I don't think we can complain about that. When you look, that's a risk on barometer. And then you're sitting in this backdrop of, at the end of last year, we ended up breath-wise getting really narrow. You had the bullish percent down into 40s. We flipped back to X's, and you're coming off back-to-back years where less than 25% of stocks in the S&P outperformed the S&P itself, which is a little abnormal, but markets are normally abnormal.
Right.
So is 2025 a year where you see an increase of stocks, the S&P 500?
Yeah, I think it definitely could be. Even just scanning through individual charts within some of these different sectors, I think you're definitely seeing good looking charts, and kind of from some not necessarily common names or areas that were doing well last year. So, yeah, very well could be kind of like an intra-sector rotation happening.
Yep.
A little bit of greater participation. And
to start the year, 50% of S&P 500 constituents are outperforming S&P, which is pretty dramatic change from the last 2 years where less than 30% were outperforming the S&P. So year to date, you have greater than 50%. You might have a character change, and you talk about rotation. That's the lifeblood of a market when you see that type of rotation. Until we start to see credit really crumble, you have to give the nod to the trend that's in place. And you're seeing things like financials leading.
Mm-hmm.
You typically don't see financials do well if a bear market is upon us. It's just not something you see. Typically it's staples, utilities, some of healthcare, but we're not seeing that. You have financials as a whole being the best sector year to date at almost 8%, along with communication services, materials, industrials. Not a lot to complain there. And then you look at individual stocks like JP Morgan or American Express versus XLF financials. JP Morgan versus S&P is about a breakout of a 30-year base. Does that happen next week? Don't know. But American Express versus the S&P already broke out of a 52-year base. And the bigger the base, the higher the space.
Right.
And then I would say there's a term in our industry overused, which is inflection point. And when you look at semiconductors and tech versus the S&P, they're really at important levels. And I think that's really going to be the tell in the coming weeks, is when you look at versus S&P, whether they can hold this neckline. Same with XLK versus S&P. If those hold and those end up being quote unquote head and shoulders consolidations rather than tops, this could be a rip roar in 2025.
Mm-hmm.
Pivoting back to financials, I know you highlighted before we hopped on here, just broker dealers.
Yeah. You're talking about relative bases there. It's 15-year relative base it's moving out of today. Right. This week, I guess I should say, which is a pretty good sign. So we've been seeing like a lot of those investment banks, brokers, dealers, managers. That space of financials has been pretty consistent for a while, even before some of your bigger banks really started taking off. So those have continued higher. Yeah. especially with credit card names too. I was looking at Discover today too, relative to the S&P, trying to get out of, call it like a 10-year base, relative base.
12 years, man.
So credit cards looking pretty good.
Well, and you know what? One unique area that, if we preach that markets are a future discounting mechanism, and I shouldn't say preach, it's just a fact they are. One area that you highlighted this week, you and Ian, that I thought was really interesting is just education stocks.
Yeah.
And I'm not saying that's risk on or risk off. It's just interesting to note the strength out of education stocks that I haven't heard anybody talking about that.
No. I mean, really, it's kind of an area that there's no easy way to access an aggregate really anymore.
No.
Which always makes it interesting when you see some of those, themes or industries that kind of play out where there's no underlying, basket that people can just buy that might be kind of driving it. So that's pretty cool to see.
It is. And then when you look at things like crypto, I know altcoins, some call them crap coins, or maybe even more derogatory terms, has been quite a sell-off, a bloodbath over the past few weeks. Meanwhile, your majors, your Bitcoin, Ethereum, Ripple, they've actually held up pretty well and remain in ranges. We'll see how those resolve. There's pretty important lines in the sand. Again, there's a lot of pieces. Like you look at crypto, even commodities as a whole, using something like GCC at a really critical point on an absolute and relative basis, we're seeing the market set up that if the uptrend is intact, you'll see these things confirmed to the upside. And if we do have a major correction upon us, you can see things like semiconductors versus S&P, tech versus S&P, commodities versus S&P, Bitcoin versus S&P. They'll confirm, they'll let us know whether we have a correction on our hands and we can adjust for our clients accordingly. We're just not there yet. I mean, there's still really good setups that are happening. And when you look at enough charts, there's quite a few things coming out of bases. It's a market where you could see some weakness in February, but things have really set up to give us some information here soon. And that's why I appreciate technical analysis. I don't know how you do this from a macro or fundamental perspective where you have this acute point in time where, okay, price on a relative basis is really at a bunch of these important levels. We're about to get some really important information soon.
Right. Yeah. And especially, like a lot of individual stocks within a lot of these sectors up against relative resistance and kind of forming bases and pretty good setups.
Yeah.
Kind of your point you were making before, we've seen kind of an relative breadth expansion. I mean, setups are there. You just need to follow through on them.
Mm-hmm. And there could be a scenario where is February just one big shake and bake? February is just those levels actually break and they turn into false moves and we rip higher the rest of the year. Also a scenario, or do they break, confirm, and they have sustained trade and there is a major correction upon us, or they never break and we're ripping the rest of the year. So really 3 scenarios on our hands. And I know we're reaching the end of our time. And so I got to make sure that I highlight the supporter of this podcast, which is the Adaptive Select ETF listed on the New York Stock Exchange under ticker ADPV, which helps investors access 2 of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. So Kevin, we've reached the end of our time. Anything else you'd like to highlight before we hop off of here?
No, I don't think so. I mean, we had some sentiment things that were put out there in the universe about some skepticism increasing.
Yeah, I think that's fair. The AAI bull bear ratio definitely would still scream skepticism. I know bar charts shared data that 43% of investors are expecting a correction over the next 6 months. That does not reek of optimism. So sentiment continues to be what I would call a tailwind. People remain skeptical of this market. We're seeing the put call ratio rise over the past few weeks. All put buyers are future buyers of stocks when they got to cover. So we'll see. Time will tell.
Yeah.
Great point.
You're still definitely more in the good category, right? I mean, if you start, like, if we ever have an episode here coming up where we don't have any red flags, then it's attention.
Yep. I completely agree with that. It's when everything is swimmingly going well and all the boxes are checked that you really need to pay attention on, have we exhausted the buying? Well, great having you on here. Thanks for covering. Great episode. Everyone that's listening, if you enjoy this, please share it. Please give us a high ranking on your platform of choice. Enjoy the weekend. I think Super Bowl should be on a Saturday, so Mondays are more productive, but it is what it is. Enjoy watching the game. And thanks for listening.
Yep. Thanks. Have a good weekend, everybody.